This is not normal price action. In the early hours of a thinly traded session, outside regular U.S. market hours, silver futures moved sharply higher in a compressed window of time. Liquidity was limited, order books were shallow. There was no single headline that justified the magnitude or the timing of the move, yet the market reacted decisively. This did not occur during a major data release. It did not occur during a central bank press conference. It happened when participation was low and price discovery is typically most fragile. That matters. Before we go any further, a brief clarification. This is not a recommendation. There are no products being sold here. There are no paid alerts, no funds, and no signals. This is an analysis of a market event and what it may be communicating about broader conditions. Silver is often treated as a secondary asset. It sits between categories. It is both a precious metal and an industrial input. It trades in financial markets, but it is also consumed by manufacturers. That dual role is exactly why sudden, abnormal price behavior in silver deserves attention. Because when silver moves this way, the market is not speculating, the market is signaling. What makes this moment more significant is not just the short-term move, it is the longer-term context. Even after recent volatility, silver remains roughly 80% below its inflation-adjusted high reached more than 4 decades ago. In real terms, silver has never recovered. That is not a trivial statistic. It is a structural anomaly. This script will explain why that gap exists, why it matters now, and what the recent price behavior may be revealing about global markets, the U.S. economy, and the structure of the financial system itself. The abnormal price signal. The first issue to address is the nature of the move itself. Markets move every day. Volatility by itself is not evidence of stress. What distinguishes a routine fluctuation from a meaningful signal is context, timing, liquidity conditions, and correlation with other assets. This move in silver did not occur during peak trading hours. It occurred when participation was thin and when price impact per unit of volume is highest. In such conditions, prices usually drift, not surge. When a market accelerates under those circumstances, it suggests urgency rather than enthusiasm. Urgency implies that someone needed exposure immediately. It implies a willingness to pay up in an environment where patience would normally be rewarded. That behavior is not characteristic of short-term speculation. It is characteristic of hedging, risk transfer, or supply-related concern. This is reinforced by the absence of a single catalytic headline. There was no earnings report, no policy announcement, no sudden change in interest rate expectations. When price moves without a clean narrative, the narrative is usually internal to the market itself. In commodities, that often means stress in availability, stress in delivery mechanisms, or stress in confidence that existing inventories are sufficient. Silver is not a large market. It does not require enormous capital flows to move price, especially off hours. That also means it is sensitive to marginal changes in demand. When even modest flows produce outsized moves, it tells us that liquidity is thinner than expected. Liquidity is not just about volume. It is about the willingness of counterparties to take the other side. When that willingness declines, price becomes unstable. The market is signaling that silver is not being treated as a passive asset at this moment. It is being treated as a problem that needs to be solved quickly. That is the first warning. Geopolitical catalyst markets do not exist in isolation, and commodities least of all. Silver sits at the intersection of multiple geopolitical fault lines. It is mined in politically sensitive regions. It is refined through globally distributed supply chains. It is consumed by industries that are now considered strategic, including energy infrastructure, electronics, and defense-related manufacturing. The current global environment is defined by fragmentation rather than integration. Sanctions are no longer exceptional tools. Export controls are increasingly normalized. Resource nationalism is no longer theoretical. Governments are explicitly prioritizing domestic access to critical materials. Silver is not officially labeled a strategic metal in the way rare earths or uranium are, but functionally it is becoming one. Its role in solar energy, grid expansion, and advanced electronics places it squarely within the scope of industrial policy. At the same time, geopolitical instability has increased demand for neutral stores of value. When confidence in cross-border settlement declines, capital looks for assets that are not someone else's liability. Gold is the primary beneficiary of this dynamic, but silver often follows with leverage because of its smaller market size and hybrid role. What matters here is not any single conflict or sanction. It is the accumulation of constraints. Each additional trade restriction, each new geopolitical fault line increases the friction in global supply chains. That friction does not always show up immediately in headline inflation. It often shows up first in commodities that straddle financial and physical demand. The recent price behavior in silver suggests that this friction is no longer abstract. It is being priced imperfectly and unevenly, but increasingly urgently. Capital is being reallocated not because of optimism, but because of risk management. When geopolitical risk rises, markets do not wait for confirmation. They move preemptively, especially in assets that can be accessed quickly. Silver's move fits that pattern. It reflects a market that is beginning to treat geopolitical instability as persistent rather than temporary. U.S. economic vulnerability. Silver is deeply embedded in the U.S. economy, even if it rarely receives attention. It is a critical input in electronics, medical devices, renewable energy systems, and automotive applications. It is not easily substituted without performance trade-offs. That means price changes in silver eventually feed into production costs. When silver prices rise sharply, especially under abnormal conditions, it raises questions about future cost pressures. This is not headline inflation. It is pipeline inflation. It affects margins first, then prices, then investment decisions. The U.S. economy is already navigating a complex environment. Fiscal deficits are large. Monetary policy credibility is being tested by the persistence of inflation above target. Supply chains, while improved from their worst disruptions, remain vulnerable to shocks. Silver's behavior suggests that the market is reassessing those vulnerabilities. It reflects concern that the system has less slack than previously assumed. There is also a confidence component. Precious metals do not only respond to inflation data, they respond to trust in institutions. When confidence in long-term monetary stability weakens, even slightly, assets with no credit risk become more attractive. Silver's underperformance relative to gold over the past decades has often been interpreted as a sign of its industrial character dominating its monetary role, but that interpretation assumes stable growth and predictable policy. When those assumptions weaken, silver's monetary characteristics reassert themselves. The fact that silver remains so far below its inflation-adjusted high underscores how little of this risk has been priced over the long term. The recent move does not close that gap. It merely highlights it. The U.S. economy is not breaking, but it is being tested, and markets tend to test assumptions before they test outcomes. Market mechanics and structural stress. To understand why silver can remain deeply undervalued in real terms while exhibiting sudden bursts of volatility, it is necessary to examine market structure. The price most participants see is a paper price. It is derived from futures contracts, options, and other derivatives. These instruments are efficient for trading exposure, but they are not equivalent to physical availability. In normal conditions, the linkage between paper and physical markets is stable enough that the distinction does not matter. In stressed conditions, it matters a great deal. Silver futures trade almost continuously, but liquidity is not uniform. During off hours, a relatively small imbalance can move price significantly. That is not manipulation by itself. It is a structural feature of the market. What becomes concerning is when these anomalies repeat. When price dislocations occur frequently, it suggests that the buffer between paper supply and physical reality is thinning. There have been periodic signs of tightness in physical silver markets, elevated premiums, delivery delays, and regional shortages. These do not always translate into higher futures prices immediately, but they create latent pressure. Backwardation, where near-term prices exceed longer-dated contracts, has appeared intermittently. That is unusual for a metal that is expensive to store and finance. When it occurs, it signals immediate demand relative to available supply. The persistence of large open interest relative to known inventories also raises questions. Futures markets rely on the assumption that only a small fraction of contracts will ever stand for delivery. That assumption holds until it does not. The recent price action suggests that participants are paying closer attention to these mechanics. It reflects concern not just about price, but about access. When markets begin to price access rather than exposure, structural stress is present. The bear case and risk factors? A credible analysis must acknowledge risk in both directions. Silver is volatile. It has a history of sharp advances followed by equally sharp reversals. Liquidity can disappear quickly in both directions. Intervention, whether explicit or implicit, is always a possibility in commodity markets. There are also legitimate reasons why silver has underperformed in real terms. Technological efficiency has reduced silver intensity in some applications. Recycling contributes to supply. Investor interest has been inconsistent. Macroeconomic conditions could also shift. A sharp slowdown in industrial demand would weigh on silver. A strengthening of the U.S. dollar or a restoration of confidence in monetary policy could reduce safe haven demand. Historical precedent matters. Silver has experienced episodes where compelling narratives failed to translate into sustained price appreciation. Forced selling, margin calls, and broader risk-off events can overwhelm fundamentals in the short term. These risks do not invalidate the signal. They contextualize it. Markets rarely move in straight lines, and early warnings are often noisy. Ignoring downside risk does not make analysis stronger. It makes it less credible. Keynote 6: Strategic Reframe and Long-Term Implications. The most important point is this. The recent move in silver is not a prediction. It is a message. The market is signaling that assumptions are being questioned, that liquidity is thinner than believed, that geopolitical and economic pressures are intersecting in ways that are difficult to model. Silver's position far below its inflation-adjusted high is not proof of inevitable repricing. It is evidence of a long-standing divergence between paper valuation and real-world complexity. This divergence can persist for long periods. It can also close suddenly. There is no schedule. What matters is awareness. Understanding that price is not just a number but a reflection of confidence, access, and structure. The recent abnormal price action does not guarantee anything. It does, however, suggest that risk is being repriced at the margins, that stress is appearing where markets are least robust, that confidence is being tested quietly, not dramatically. This is not about optimism or fear. It is about responsibility. This is your capital, your future, your responsibility. The abnormal price signal. The first issue that must be addressed is why this move in silver cannot be dismissed as routine volatility. Markets fluctuate continuously, and price changes alone do not constitute a signal. What matters is the context in which a move occurs. In this case, silver advanced sharply during a period of thin liquidity outside normal U.S. trading hours, when participation is limited and price discovery is most fragile. Under such conditions, markets typically move slowly, if at all. When they move aggressively, it suggests something other than casual positioning. This was not a response to scheduled data. There was no inflation release, no employment report, no central bank communication. There was no single geopolitical headline that would conventionally justify an immediate repricing, yet price accelerated. That absence of a clean narrative is itself significant. When markets move without a headline, the pressure is usually internal. It reflects imbalances that have been building beneath the surface. Silver is a relatively small market. Its futures complex does not require massive capital flows to generate large price changes, especially during off hours. That sensitivity is well known. What is less routine is the willingness of participants to transact aggressively when liquidity is scarce. That behavior implies urgency. It implies that waiting for better conditions was not an option. Urgency is rarely associated with speculative enthusiasm. Speculators prefer liquidity, tight spreads, and confirmation. Urgency is associated with hedging, with inventory risk, or with the need to secure exposure before conditions worsen. In other words, the price action suggests that someone was responding to a perceived risk, not chasing momentum. This distinction matters. Speculative flows tend to fade when liquidity improves. Risk-driven flows often persist and expand into regular trading hours. The market is effectively saying that the risk of not acting immediately outweighed the cost of poor execution. Another abnormal feature is how the move interacted with market depth. Order books during off hours are thin by design. Prices can gap because there are fewer resting orders. Normally, this results in short-lived spikes that quickly retrace once liquidity returns. What raises concern is when these spikes do not immediately mean revert, or when they recur repeatedly. That pattern suggests that underlying demand is not being fully satisfied. Repeated anomalies indicate structural stress. One anomaly can be ignored, a pattern cannot. Over time, frequent off-hours dislocations imply that liquidity providers are less willing to warehouse risk. That reluctance can stem from regulatory constraints, balance sheet limitations, or uncertainty about physical settlement dynamics. Silver's dual role intensifies this effect. Because it is both a financial instrument and a consumable input, disruptions in one domain spill into the other. A futures contract is a promise. Physical silver is an object. When confidence in the smooth conversion between the two weakens, prices become unstable. The market is also signaling something about supply elasticity. In a well-balanced market, sudden demand is met by sellers stepping in. Price moves, but it does not lurch. When price lurches, it suggests that the pool of willing sellers is smaller than expected. That does not necessarily mean there is no supply. It means supply is not readily accessible at current prices and conditions. This is where timing becomes critical. Off-hours trading strips away the illusion of abundance created during peak sessions. It reveals the marginal reality. If the marginal unit of silver exposure is suddenly expensive, the market is telling you something about scarcity at the edge. It is also important to consider correlation or the lack of it. This move was not mirrored uniformly across all risk assets. It was not part of a broad risk-on surge. That isolates the signal. It points to silver-specific dynamics rather than a generalized shift in sentiment. Markets communicate through relative behavior. When one asset behaves differently from its peers under identical conditions, it demands explanation. In this case, silver's behavior diverged from expectations for a quiet session. That divergence is the message. Finally, abnormal price action matters because it precedes narrative formation. By the time a consensus explanation emerges, the adjustment is often already underway. Markets move first. Commentary follows. The recent move in silver does not tell us where price will go next. It tells us that something in the system required immediate attention, that liquidity, confidence, or access was momentarily insufficient. That is not normal price action. It is a warning that conditions are tighter than they appear during calm, liquid hours. And warnings of that kind tend to surface before broader stress becomes visible. The geopolitical catalyst. To understand why silver is behaving this way, it is necessary to move beyond charts and into the geopolitical structure now shaping global capital flows. Markets are increasingly being driven by political constraints rather than purely economic optimization. The post-Cold War assumption of frictionless globalization has eroded. Trade, finance, and resource flows are being reorganized along strategic lines. This shift is gradual, but its effects are cumulative, and commodities are where those effects surface first. Silver occupies a unique position in this environment. It is not just a store of value, it is a critical industrial input tied to sectors that governments now treat as matters of national security. Energy transition infrastructure, electrification, telecommunications, and advanced manufacturing all depend on reliable access to silver. That dependency transforms silver from a passive commodity into a strategic material, even if it is not formally designated as one. Geopolitical instability amplifies this transformation. Sanctions regimes, export controls, and investment restrictions are no longer temporary tools. They are becoming structural features of international relations. Each new restriction reduces flexibility in global supply chains. Each retaliatory measure adds friction. Over time, these frictions accumulate into real constraints. Silver production is geographically concentrated. A significant share of mining output comes from jurisdictions with political volatility, regulatory uncertainty, or fiscal dependence on resource revenues. When governments face budgetary pressure, they often turn to the extractive sector through higher taxes, royalties, or export limitations. This is resource nationalism in practice, not theory. At the same time, refining and fabrication are globally distributed. Concentration at any stage of the supply chain introduces vulnerability. When geopolitical tension rises, participants begin to question whether contractual supply will remain uninterrupted. That questioning does not require an actual disruption to influence behavior. Anticipation alone can change inventory strategies. This is how safe haven demand forms outside of traditional narratives. It is not driven by fear headlines. It is driven by uncertainty about access and reliability. Silver, because it is both a financial asset and an industrial necessity, absorbs that uncertainty from multiple directions. Capital flows respond accordingly. When geopolitical risk rises, investors and institutions reassess what constitutes security. Assets that depend on stable cross-border cooperation become less attractive. Assets that exist outside the credit system gain appeal. Silver benefits from this reassessment, but in a more volatile way than gold because of its smaller market and industrial linkage. Another critical factor is the fragmentation of settlement systems. As financial sanctions expand, the concept of neutral money regains relevance. Commodities that can be physically held, transferred, and consumed without reliance on digital settlement infrastructure become strategically valuable. Silver's role here is understated but significant. The recent price behavior suggests that some participants are positioning for a world where supply chains are shorter, inventories are higher, and redundancy replaces efficiency. That shift is expensive. It requires more working capital and more physical stock. Futures markets, which are optimized for efficiency, struggle to reflect this transition smoothly. Geopolitical risk also changes time horizons. When the future becomes less predictable, markets place more weight on near-term certainty. This can manifest as preference for immediate delivery, reluctance to roll contracts, or willingness to pay premiums for assured access. These dynamics often appear first during periods of low liquidity, when marginal decisions have outsized price impact. It is important to emphasize that none of this requires escalation into crisis. The mere normalization of geopolitical tension is enough. When instability becomes a baseline rather than an exception, pricing models calibrated to past decades lose accuracy. Silver's underperformance in real terms over the long arc of history reflects a world that believed in stability, efficiency, and abundance. The current environment is challenging those beliefs. The market is beginning to test what silver is worth in a system where supply chains are politicized and trust is conditional. The recent move does not imply that geopolitical risk has peaked. It implies that markets are no longer ignoring it. Risk is being pulled forward into present pricing unevenly and imperfectly, but deliberately. This is how geopolitical stress enters markets, not with a single dramatic repricing, but with repeated signals that access, neutrality, and reliability are being reevaluated. Silver's behavior suggests that this reevaluation is underway. U.S. economic vulnerability. Silver's recent price behavior cannot be separated from the condition of the U.S. economy because silver is not an abstract financial asset. It is a functional input embedded in the physical economy. When the market begins to reprice silver under abnormal conditions, it is indirectly commenting on economic resilience, cost structures, and confidence in stability. The first channel through which this signal operates is inflationary pressure. Silver is used in electronics, medical equipment, energy infrastructure, automotive components, and industrial controls. These are not discretionary sectors. They sit upstream in production chains. When input costs rise at this level, the impact is delayed but persistent. It works its way through margins, pricing decisions, and capital expenditure plans. This matters because inflation in the United States has become increasingly difficult to manage. Headline measures may fluctuate, but underlying cost pressures remain sensitive to supply-side dynamics. Silver's behavior suggests that the market is focused less on demand destruction and more on cost persistence. That distinction is critical. Demand-driven inflation can be addressed by tightening financial conditions. Supply-driven inflation is more resistant and more destabilizing. The second channel is supply chain fragility. The U.S. economy relies on complex, just-in-time systems that assume predictable access to inputs. While recent years have prompted some diversification, the structure remains vulnerable to disruption. Silver's sudden repricing under thin liquidity conditions suggests concern about availability rather than consumption. It reflects a market questioning whether supply buffers are sufficient. This is not an academic concern. Many U.S. industries operate with narrow inventories to optimize efficiency. That model works when global trade is smooth and financing is cheap. It becomes risky when logistics are politicized, energy costs are volatile, and capital is more expensive. A metal like silver, which cannot be easily substituted, becomes a focal point for that risk. There is also a fiscal dimension. Large and persistent deficits constrain policy flexibility. When governments carry high debt loads, their ability to absorb shocks without inflationary consequences is reduced. Markets understand this. They do not need to see a crisis to reassess sustainability. They look for early indicators. Precious metals have historically served as barometers of confidence in fiscal and monetary discipline. Silver's underperformance in real terms over decades coincided with a period of declining real yields, expanding credit, and faith in policy intervention. The recent behavior suggests that this faith is no longer unchallenged. Monetary stress is another factor. Central banks operate on credibility. When inflation remains elevated despite restrictive policy, credibility is tested. The market begins to explore hedges that are less dependent on policy success. Silver, because it is affordable relative to gold and linked to tangible production, becomes attractive in that context. Importantly, this is not about predicting policy failure. It is about acknowledging uncertainty. Markets price uncertainty before outcomes. The abnormal timing and structure of silver's move indicate that uncertainty is rising. There is also a consumer-facing dimension. Silver's industrial applications ultimately feed into goods that households purchase or rely upon. Rising costs in electronics, energy systems, and medical devices affect living standards. Even if silver itself is a small component, its price behavior reflects broader cost dynamics that consumers feel over time. Confidence is the final and most subtle channel. Economies function on trust. Trust that supply will arrive, that prices will be stable, that policy tools will work. When that trust weakens, even slightly, behavior changes. Inventories rise. Hedging increases. Risk tolerance declines. Silver's recent price action suggests that confidence is being tested at the margins. Not in a dramatic way, but in a way that prompts precautionary behavior. That is often how stress begins. The U.S. economy remains large and adaptive, but adaptability does not eliminate vulnerability. It shifts it. Markets are signaling that the margin for error is narrowing. Silver is not causing this vulnerability, it is reflecting it.